Tomorrow is by far the most important day throughout the rest of 2023. That is because we not only hear from Fed Jerome Powell and get an update from the Federal Reserve, but we also get a summary of economic projections. And let me tell you right now, today is September 19th, 2023 is over. This is the first summary of economic projections for 2024 that holds any kind of weight or credibility for the markets. What I mean by that is the Fed could tell us, hey, maybe we're going into a recession in 2024. And that would be bad news. Or maybe the Fed says we're going to get a soft landing. Maybe the Fed says higher for longer. There's a lot of potential implications here, and there is one clear outcome. A big move coming tomorrow. In this video, I'm going to give you the worst case, the base case, and the best case scenario. The best case scenario could be a 2+% day for the indexes. The worst case scenario could be 3 to 4% negative. Your base case scenario, meaning that if not too much changes, you could be up or down 0.5%. This is just showing you the degree of how important tomorrow's Fed meeting is. And it has nothing to do with whether the Fed raises rates tomorrow or not. The markets don't even care. We are also obviously going to go over the implications of how this could affect Tesla stock directly. As you know, Tesla is very sensitive to any change of Fed policy. So I think that will also be very important. We're going to take a look at some of the option activity, blow up the bubble chart of options over the next couple of weeks, and see what your hedge funds and institutions are targeting as far as a price level. So let's get into it, guys. If you like Tesla stock or if you are invested in Tesla stock, hit the like button. We need a roll call. So every time you click on this video, you see, hey, 100 other Tesla investors have watched this. 200, 300, 400, 500. Let us know if you are invested in Tesla. Hit that like button, as well as comment down below. What is your opinion for tomorrow? I think that's very important. More opinions, the better. So let's start with the summary of economic projections and what this is. So every 3 months, the Fed comes out with a new summary of economic projections. They take into account new data and changes and basically forecast for the next 2 years out where they expect GDP to be, unemployment rate, PCE inflation, core PCE inflation, and the Fed funds rate. So it changes every 3 months based on the data, just as any investor would change their mind if good or bad news came out for any company. The Fed does this in relation to Fed policy, to expectations of inflation, GDP, unemployment, as well as the Fed funds rate. So this is actually plotted on literal dots, on a dot plot for all of these things. Now, this chart that we're going to look at just breaks down the median forecast. So this is what the markets care about. This column right here, this beginning column from here to here, all of this down, all of that. So what you can see is that 2023, last summary of economic projections was June 14th. So it's comparing the March projections to the change in June. For GDP, the Fed expects higher GDP than what they expected in March. They expect higher inflation, core PC inflation, and they expected to raise rates more. The terminal rate by the end of 2023 was expected at 5.6%. Now, let me tell you right now, today is September 19th. Tomorrow is September 20th. The markets do not care at all what these 2023 numbers come in as. Unless there is some kind of big change, a big drop in GDP, a big, increase or drop in the federal funds rate, markets don't care. Okay, 2023 is over with. The column that matters here is 2024. Markets are forward-looking. A lot of hedge funds and institutions are ending their 2023 calendar year at the end of September, and they start a new one at the beginning of October. So at that point, the only thing the markets care about right now is 2024. Now, what's actually interesting about the summary of economic projections throughout all of 2023 is for 2024, the estimates for GDP have been going down. So in March, the Fed previously projected 1.2% GDP for full year 2024. In June, they now project 1.1%. What do they project tomorrow? That's the big question. Does the GDP estimates go down again? Do they stay the same at 1.1%? Do they go up? That is going to be key, because if we get anything like what we got in 2023 back in March of 0.4, well, that could be a problem. If the Fed all of a sudden expects 0.3%, you're going to be in for a very big problem. Now, let me be honest with you here. The unemployment rate at 4.5%, that's the current projection for 2024. If this goes up or down, it's not going to move the markets as much. Why is that? Well, during a recession, unemployment can go way higher than 4.5%. So this is borderline pricing in like a soft landing, like an average, just long-term unemployment rate about 4.5%. Canada's unemployment rate is 5%. Doesn't matter. It's not going to move the markets unless it comes in at like 5% or higher. What is very important, it's not inflation either. Unless there's a big jump of expected inflation, PCE is not going to matter. You want to watch the Fed funds rate projected, terminal rate, and GDP. So what I mean by this is if the federal funds rate, it's currently projected to end 2024 at 4.6%. If the Fed projects maybe the federal funds rate will end the year by 3.5%, well, that's great, right? Why wouldn't the markets love that? That's basically saying we're expecting tons of rate cuts in 2024. Well, if your GDP estimates also come down close to zero, that would just be telling you we're certainly heading into a recession. That's why we're getting rate cuts. So the Fed pricing in rate cuts, if the Fed's also pricing in lower GDP and like borderline zero for the GDP report for 2024 or for the full year, that's your ultimate worst case scenario. Is if your Fed funds rate comes in at, call it 3.5% projected by the end of 2024 and GDP around zero. That's the Fed saying we're going into recession. And the markets would panic. The markets would fall 3 to 4% based on too many rate cuts and far lower GDP than what they expected back in June. Not great. Now, the PCE, the unemployment rate, obviously if the unemployment rate rises as well in your worst case scenario and inflation stays about the same, then you got stagflation concerns. And then you got an even bigger problem. So that's your worst case scenario. Your best case scenario is if GDP expectations rise, your unemployment stays the same or actually goes down. Your inflation, that doesn't even matter at this point. I don't expect that to move like at all. It usually doesn't. And your Fed funds rate stays about the same. The markets don't want to see a bunch of rate cuts at this point. They just don't. Because if you have a bunch of rate cuts without inflation at 2%, something dramatically went wrong. Now, in a theoretical best case scenario, I don't think this is likely at all, but if the Fed projects core PC inflation at 2%, and you were to see the Fed funds rate get projected at 3.5%, that would be your soft landing kind of being priced in, as long as your GDP did not fall and your unemployment rate did not rise. That would be your best case scenario. PCE at 2%, federal funds rate at 3.5% by the end of 2024. That would be awesome. That would be great. Odds are that's not what we're going to get coming tomorrow. That would be the outcome in which I would expect the indexes themselves to rally 2% or more. I think your Russell stocks, your stocks like your small caps, would rally even larger than that. Probably 4% or more, because they have really been the ones getting destroyed over the past 18 months or so because interest rates have been high and the Fed has been saying they're going to keep interest rates higher for longer. Again, markets fall 3 to 4% if GDP expectations from the current expectation of 1.1% come in at maybe 0.2%. That would be one of those things where markets would say, hey, what happened from June until now that the Fed is expecting GDP to be so much lower in 2024? Is it the UAW strike? Is it student loan repayments starting in October? Is it credit card delinquencies, auto delinquencies? Does the Fed know there is a problem out there? Something is breaking. In a 3-month time span, the Fed should never go from 1.1% GDP expectations down to 0.2 or 0.3. But why I'm even bringing this up as a possibility, the Fed basically did that to the opposite last time. The Fed increased their GDP expectations for 2023 from 0.4% to 1% at the last summary of economic projections. So if there is a problem, and we are going into recession like a lot of people are starting to suspect, myself included, GDP expectations could fall a lot. Now, if the Fed funds rate projected terminal rate by the end of 2024 also comes in, call it 3.5%, then you got a big problem. Then the markets fall 3 to 4% tomorrow. Now, in the specific outcome that causes a very small move up or down 0.5% is if nothing really changes. And I think that's a possibility. Maybe your GDP estimates go down a little bit. Maybe your unemployment rate stays the same. Your PCE stays the same. The federal funds rate, projected rate, stays the same. That's possible. To some degree, the Fed does want to see expectations come down for 2024. And what I mean by this is theoretically, if the Fed were to give us a really bad kind of different summary of economic projections, come in with that worst case scenario that I'm outlining here, that's very disinflationary. Very disinflationary. If the Fed basically says we're probably going into a recession in 2024, prices will not go up. The price of oil will fall off of a cliff. You'll probably see oil down 5% tomorrow. Because if you go into recession, that's less demand for oil. That's less demand to travel. And that is exactly what the Fed would actually want to see happen. That's exactly what the Fed needs to see happen. So maybe it's my tinfoil hat, who knows, but it does seem like it's a logical move to get a little bit of fear in the markets, to get investors to kind of price in the odds of a recession again. The markets, there is like 2% chance of a recession based on what stocks are pricing in. You're almost at all-time highs with almost record high valuations. There's no recession priced in. That is very inflationary. That's an inflationary kind of environment. But if you change expectations and now markets start to expect there could be a recession, kind of like what we seen in October of 2022 for the S&P, when we were hitting the lows, inflation expectations hit the lowest point you have seen. That's kind of what the Fed wants to see. Now, if you crush expectations up here, you probably don't fall all the way back down to here. You probably fall to about here, the 400 level on the S&P. That's a lot better than plunging and being down, 30, 35% from highs, if the Fed were to have done that back here. So hopefully this makes some sense. It's kind of in the Fed's best interest to scare the markets a little bit, to get that disinflation to really pick up. Then again, what the Fed should do and what the Fed does are totally different things. The Fed should have stopped raising rates a long time ago because it looks like we're already heading into a recession. And the UAW, that strike, is not helping things whatsoever. And that could actually help do part of the Fed's job for them if 6 jobs depend on every 1 UAW job. I mean, you've already seen thousands of individuals get hurt by this situation. That's very disinflationary as well. So that is a new development since the last Fed meeting that I do believe the Fed will highlight. And if the Fed does expect lower GDP and come in kind of recessionary like in their projections, then the UAW strike probably has something to do with it. Student loans kicking in October, that probably has something to do with that as well. You also want to watch the Fed rate monitor tool. So tomorrow there's a 2% chance of a rate hike. We're not going to get a rate hike. It's 98% chance that we're going to stay paused with the Fed. And now for November, December, all of the other Fed meetings, we're not expecting any more rate hikes. And I don't think we're going to get any more rate hikes. I think that would be just way overkill for the Fed. It's possible the Fed could overkill us, or the Fed could just crush expectations of inflation by saying we're going into recession. That's possible as well. So there's big outcomes, big spectrum of potential outcomes coming tomorrow. But what you really want to watch is your June and July Fed futures. So for June, there is a 35.5% probability of a rate cut. There is a 34.9% chance of a continued pause. So the markets here for June are like literally a coin toss on whether we're going to get the first rate cut or see the Fed continue to pause. And this just flip-flopped today. Earlier in the day, the markets were still at a coin toss, but expecting the Fed to continue to hold. Well, for July, this is where things get pretty interesting. This is where the expectations really start to branch out. The current pricing is 35.2% chance we get at least one rate cut by July 31st. There is 24.5% of a chance that we get 2 rate cuts by July. Get this. There's a 23.9% chance the Fed holds until July. So in other words, there is a higher likelihood that we get 2 rate cuts by July 2024 rather than the Fed holding rates where they are until 2024 or until July of 2024. That's wild, actually. And then there's a almost 8% chance we get 3 rate cuts by July. And there is about a 1% chance we get 4 rate cuts by July. 4 rate cuts by July, if you start to see these probabilities going up, the 8% and the 1% probabilities, that's where the markets start to really panic. That's where you get that 3 to 4% down move. If the Fed is pretty aggressively expecting to cut rates. And it's a possibility that we do get that inclination from the Fed. Those of you guys that watch all of these videos here on the channel know that I am not so bullish on the next couple of weeks, but I'm very bullish for 2024 in regards to Tesla stock. Now, why so? Well, expectations are too low for Tesla, blah, blah, blah. You know why we're bullish on Tesla. You know the good that is likely coming for Tesla in 2024. I'm not so bullish on the broader markets or specific Tesla price action over the next couple of weeks. Why? Because if the broad markets come down, in which I expect they will, it's going to drag down Tesla as well. So whatever happens tomorrow is going to have a big impact also to Tesla stock, unless Tesla comes out with some really good news tomorrow that kind of counteracts any kind of market trend, which that's a fool's game to try to predict what day big news is going to come out. That's just, you can't do that. So with that being said, the risk to reward in this market makes no sense to me why you would be bullish right here, near all-time highs, given in the grand scope of things, earnings have been pretty bad for big tech. Big tech is not growing. Inflation has been high. The Fed's going to be higher for longer. And if they're not, they're going to cut rates more than we expect. But the only way they cut rates more than we expect is if we go into a recession, in which that is not priced into markets. More rate cuts and a recession is not good for markets, even though it's rate cuts and you would think it would be good for markets. No, if rate cuts come because there's a recession, that's not great. If we avoid a recession but rates stay higher for longer, eventually that catches up to the market. So I'm not very constructive over the next couple of weeks until we get more clarity on whether we're going into recession currently or if there's no recession. once we have that kind of clarity, I think the markets can be a little bit more stable and actually hold some of these gains that we have seen over the past 6 months or so, 9 months or so. But until that happens, I am not very bullish. But tomorrow could be a step in the right direction. If the Fed does not give us anything to panic about, then you de-risked massively because you just got the Fed out the way and you didn't crash. So I'm not very bullish on the broader markets over the next couple of weeks. Very bullish on Tesla heading into 2024. Now, if the broader markets play their magic on Tesla, and if the broader markets fall, dragging down Tesla, $203 is that level to really be watching. That's the 200-day moving average. There's obviously the 50 and the 100-day moving averages in here as well. You did bounce off of the 100-day moving average. That is now sitting at $235 per share. That would be a strong level of support. If you fell under that, then you'd be watching the 200-day moving average. And also 260 seems like a pretty solid level of support as of right now. But if we do get upside, well, you just got to break above this line, and you could be in for some very big upside. Back into the $300 range if the markets do like if they like what Fed Jerome Powell says tomorrow. I think it's pretty unlikely, but if the markets do, then you could be back into the 300s very, very quickly for Tesla stock, guys. So hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with us live in real time, come hedge out your portfolios if that's what the summary of economic projections warrants, then link down below. We are actively hedging out as of right now. And tomorrow, as soon as that SEP comes out, you will have that information. So no matter if the markets go higher or lower, you will know instantly whether it is bullish or bearish, whether it is good news or it's bad news, no matter what. No matter if the markets are going up on bad news and then to 5 minutes later, 10 minutes, 20 minutes later come down. You're going to know. So hopefully you're going to be able to make some big money off of that information. But nonetheless, that is going to do it for this video. I will see you guys in the next one.